Part 3, investing for retirement. Let's add this. For noobs. Investing for retirement for noobs. So in this one, we're going to talk about what we actually invest in. So in the last video, I talked about retirement accounts and how they're vehicles that you can use to save some money on taxes, which if you invest for a long time might be a lot of money that you're going to save on taxes. And in the first video, I explained why we invest it all and how we use compound growth to increase the value of our money. So in this video, we're going to talk about investing for retirement, noob version. So what are the types of investments? I googled types of investments. For the most part, I'm going to be talking about stocks and bonds in this video because these are the most common investments we'll use within a retirement account. You also have all kinds of investments. You could buy a bunch of apartments and expect, to make money off your apartments. That could be an investment. In fact, you could buy paintings and maybe the painting will sell for more money in the future and you think that's going to be a good investment. So there's all kinds of things you can put your money towards and expect them to grow. In this video, we're going to be talking about stocks and bonds. So I'm just going to go through the basics of what they are, some very high level basic concepts. So stocks. What are stocks? Basically, if you buy a stock, you own a small portion of a company. So for example, you can buy stocks for every publicly traded company, which just means that they're not a private business. And the idea is that the company's value will increase over time, so what you bought, the value of that will also increase. And what we know is that that's not always the case. The company's value might decrease. The company might not succeed, and there might be issues with their business plan, or they might have crazy presidents and, chairmen that do crazy things. So we don't really know what's going to happen with any given individual stock. But the idea is that we want to buy stocks where we think the company's value will increase over time, and therefore so will the money we bought it with. So let's just look at a stock. So right here, I googled Apple stock. Everyone knows Apple. Everyone uses iPhones. Apple, I believe, is actually the biggest company in the world right now. So I searched largest companies. Look at this. Apple, number one, $2.351 trillion is how much they're worth, which is just crazy. You'll recognize quite a few of these companies. Microsoft, you got Google, Amazon, Tesla, Johnson & Johnson, And then as you start to get down in here, you might not actually recognize as many of these companies as you might think. But this is currently the biggest companies in the world. So you could buy Apple stock. So for example, this is Apple, and you could buy their stock. So for example, you could buy one share of Apple, which would cost you $147.81. And so the idea is that if I have $147 right now that I earned, and I could put that and buy a share of Apple. And the idea is that if I do that and the company grows over time and gets more valuable, this might turn into a larger number, right? This 147 might turn into 160. And therefore, if I were to sell this, then I would have made that difference, and that would be a profit, a gain that I made. And so in last video, I talked about how we use retirement accounts such to get some tax advantages when our investments grow. So if I put Apple inside my Roth IRA or inside my 401k, and it grew, and I sat it in there until I was 59 and a half, it might grow quite a bit, and then I could sell it at that age, and I wouldn't pay taxes on any of the gains that I saw. So for example, you might have bought Apple, way back here when they were starting out. Let's say you bought Apple right in here. $3 for a share. You could have bought $5,000 worth of Apple stock right here. And look at you. You're sitting right pretty today because all of a sudden the price of Apple has gone up incredibly. And look at that. What if you had put basically all your savings, in 2006, February 3rd, 2006, you just decided, I'm going to buy a bunch of Apple because I think it's a good company. And you put a bunch of money into it at super cheap. And then all of a sudden, look, over time, your money just grew and grew and grew. And look, here you are, and the value, you bought it here, but now you own it here, so it's so much more valuable. So this is the idea of stocks, is that they can grow, and your money can grow with them if you own part of them. So that's what a stock is. Before I move on, I want to also talk about some stocks that don't look like Apple, because this is a very rare case, an incredibly rare case of a stock. So let's look at AT&T. This is another massive company, right? And it turns out stocks don't always go up. So if we look at this plot, look at this plot is not just going straight up like Apple. In fact, you could have bought it here. You could have bought shares of AT&T here at $38 in May 21st, 1999, and you were hoping that money went up, but instead, look, today you're way down here, so you've lost some money on this, in fact. You've lost quite a bit of money on this, in fact, and this is a massive company. This is AT&T. We've all heard of AT&T. This is a huge telecommunication company. Look, world's largest telecommunication company. And yet, it's not guaranteed that when you could have bought, AT&T anywhere in this area or in this area or anywhere in here, and you might be losing money on this investment. So this is the idea that stocks can also go down, and in fact, a lot of them do. And it's not very clear whether they're going to go up or down. You might have bought AT&T in here and been super excited and sold it here, and sure, you could have made some money, but you also could have bought AT&T when it's high and then sold it when it's low, and therefore you're losing money. So that concept is what you'll hear about stocks, where they always say to buy it low and sell it high. That's the classic saying. Buy it when it's down and sell it when it's up. I would argue that that's not a great strategy, and in fact, trying to time when you buy it and sell it at all is not really the greatest way to go about it. And I'll talk about that in the future, in some future videos. But for now, we're just looking at some examples of some stocks that I wanted to point out. Here's another massive company that you would be sad to have bought it at certain times. This is Intel Corporation. They make semiconductors. So right here, semiconductor chip manufacturer, the world's largest, in fact. And you might think, well, a company that makes the world's largest, I guess the company that has the most semiconductor chips manufacturing would be doing amazing, because every new phone, every new computer, all this new technology needs semiconductors to run. So you think, if you're the company that owned the most semiconductors or whatever, you would think this company should be amazing, and so this stock should be incredible. But it's not necessarily the case. And this is part of why investing in stocks is considered risky. So you might have bought Intel Corporation, somewhere in here, and been very happy to sell it way up here at this sharp peak. But if you bought it at this sharp peak in July 2000, and you thought, oh, at the time you think this is just going to keep going up. But look, history will show you that you could have bought a bunch of this stock here, and you're sitting here, 20 years later, and the value of the stock is way less than what it was 20 years ago. So it's not a guarantee that stocks are going to go up or down. In fact, it's super hard to predict it. Essentially, you have to accept the idea that nobody can predict what will happen. And so, sure, Apple right now might look incredible, but who's to say that if this graph extended into the future 20 years, it wouldn't just look like one of these companies. These huge companies that you think this is surprising. Like AT&T won't do bad. It's this massive company. They can't fail. But it turns out history will tell us that it actually can. Apple might be right here at the top, currently, and they might fall off the face of the earth. Who's to say? Only time will tell. So investing in stocks is inherently risky. And so the idea is that because they're risky, they also could reap bigger rewards. So it's risky to buy Apple, but look, you might have this huge increase in profit. Your money might grow, and you might sell and make a ton of money. So there's a risk and reward ratio to these types of things. So that's kind of some of the basics of stocks. Now let's look at bonds. So bonds are a little bit more confusing. They're maybe a little harder to wrap your head around what's actually happening. I'm going to just talk a high level about bonds. So this little image here. A bond is issued by a government or corporation to generate funds and is paid back to the investor as principal plus interest. So with a bond, the idea is that, let's give an example. You could buy a bond through the U.S. government. So the U.S. government might think, okay, we need $10 million to, fund this project. So let's just say, for an example, that the U.S. government wants to build a new highway or something in a city. They're going to need money. So kind of one way to go about this as the government is to say, okay, we could issue a bond where a bunch of civilians, you and me, give the government some of our money now. And the idea is that they're going to use that money to perform this project, and then they're going to pay us that money back in the future, but we're going to get some interest rate on that. So we're going to make, some percentage of money off of that. And so the interest rate of a bond could be linked to what I was using for interest rate on my compound growth calculator. So that's the idea of a bond. So you can essentially buy both of these, and many people use both of these in their retirement accounts. A general rule of thumb is that stocks are more risky, and therefore you might have better profits, and bonds are less risky. And so the risk that's associated with a stock is that the value of the stock might fall, at any given moment, the value of a stock might be falling. So if you look at just today, this is Apple just today. What I was looking at was just a maximum view of the company, but if we just look at today, the stock price is rising and falling constantly. So it's hard to say whether it's going to rise and fall. Over the last 6 months, you could buy it down here and sell it up here. You could buy it here and sell it down here. So it's hard to say. It's risky. You don't really know. Nobody really knows what's going to happen. If we look at AT&T, it's definitely going down at times, and it's definitely going up, basically. So you don't really know what's going to happen. It's hard to predict these types of things. If you let's look at Tesla. Tesla stock is like crazy volatile sometimes, as with a lot of stocks, because Elon Musk might send out a tweet and people don't like it, and then the stock price falls. So it's really crazy. The system is hard to predict, and it's not worth trying to predict, in my opinion. So stocks are risky, right? At any given moment, people might just sell a bunch of shares, and the owner of the company might do something crazy. So it's hard to say what's going to happen. So they're risky. That's the inherent risk with buying a stock. With a bond, the risk is a little bit less, so bonds are considered less risky than stocks, because the idea is that, okay, I gave the U.S. government my money from that example. Maybe they just decide not to pay me back. And so that's the kind of the risk that's associated with it, is the U.S. government could decide to just not give me my money back. I gave them the money, and then they might just say sorry. And so that's pretty unlikely. So a bond issued by the U.S. government is considered about as safe as it gets, because we trust our government to pay us back, basically. But that's not to say that it couldn't happen, and so there is some risk. It's riskier than just saving that money and keeping it as cash in your bank account. So that's the idea. And so essentially, with how do we choose between stocks and bonds? Well, it boils down to essentially these concepts. We want our money to, the value of our money to increase. So we want to take some risk in order to try to get some reward. And so one other thing that you want to do is you want to be diverse. So rather than just buying Apple stock, you could definitely just buy Apple stock, but what if Apple just plummets? Then if all my eggs are in one basket, if I had just bought Intel somewhere in this area, 20 years later, I would have lost so much money off this. So it's super risky to do this. And you don't want to put all your eggs in one basket. And luckily, we don't have to. So we can actually create diverse investments very easily these days. In fact, you could basically invest in the S&P 500 index. This is something I talked about in the first video. This is the 500 biggest companies in the US. So this is performance of 500 largest companies listed on the stock exchange in the US. So you could actually buy something very similar to this. And rather than owning one company that could do poorly, you might actually own 500 companies, a little portion of each 500 companies. So you want to, this is like an example of how you can diversify. It's very, very incredibly risky to put a lot of your money or all of your money into a few individual stocks. And it's something that, as an average investor, just doesn't make a lot of sense. There's really no way to know what's going to happen. Who knows if Apple will continue to grow? It's super hard to say. It might feel like it in real life, because you see everyone using iPhones, but the fact of the matter is that we know from history that any given stock might not succeed in the future, and it's incredibly hard to predict. So the goal is to diversify your investments, and that's why you hear a lot about diversity, because no matter how surefire it seems to buy certain companies, they could fail. And so if you own a lot of companies, some will fail and some will succeed, and generally speaking, you hope that the ones that you own are succeeding. So we can buy these things. We can buy stocks and bonds inside of our retirement accounts. And so that's essentially like how most people go about investing in their retirement accounts. And you can put, there's all kinds of craziness with what you can buy, how you can buy it, and all this stuff. But simply put, the easiest way to go about it is to buy both stocks and bonds, some ratio of them, and diversify them by buying lots of different types of companies and lots of different types of bonds. And then with this diverse package of stocks and bonds, you let that grow over a long period of time in a retirement account, like an IRA, and then you hope that all those investments grow. And so if you have these investments growing, the rate at which you have those investments growing is essentially the interest rate on your future value calculator, what I showed in the previous two videos. So that was just kind of me explaining, different types of stocks. There's a bunch of different types of investments, just a real basic level of what a bond is. And in some of the next videos, I want to actually show some examples of what I've bought, what I suggest you might buy, and how you do this, how you diversify your portfolio and kind of choose your level, your expected level of risk versus reward. So yeah, just know that you don't want to be a homeless bum, and you never want to end up like this one here.